Hello, this is Steve Nison. Welcome to our next edition of Highlights. Today we're going to be going over what I call being a market chameleon. Just as a chameleon changes its color to the environment, so we need to change our stance according to the market's environment. So this is really adapting to the market. Now at the red arrow we have a shooting star. And to refresh your memory for those new to candlesticks, a shooting star is a candlestick line with a very long upper shadow, small real body at the bottom end of the trading range, and little or no lower shadow. And what's very simple yet very powerful about the candlestick charts is they visually represent who's winning between the battle of the bulls and the bears. So here with this extended long upper shadow, the market is rejecting higher levels, so we're seeing a potentially bearish reversal signal. Now, many of these candlestick signals can be used as support or resistance, so the higher the shooting star should be resistance. Now, the market, although it did push above it over here on an intraday basis, it finally closed above it, and that's important. When I talk about support and resistance, I talk about based on a closing basis. So the market closed above the resistance area. Now, the market was in a congestion band over here, okay, and the Japanese call this a box range. So a breakout from a congestion band is actually usually quite positive. So on this session, the market looked fine. It was a bullish breakout. Now, remember what I said, we're looking at adapting to the market. We're all detectives in the market. We have to pick up the clues that the market sends out to us each and every session. And what the candlesticks really shine at is letting you get those clues ahead of your competition. Case in point, look at, first of all, this blue arrow points to that, the breakout above the resistance area. Now, look what happened in the next session. The doji. Doji is when the opening and closing are the same. And it's telling us, as the Japanese would say, the market's tired. So in one session, the whole tone of the market had changed. It's gone from a bullish signal, in other words, a breakout above resistance area, to one in which the market's in balance between the bulls and the bears. And this is what's great about the candlesticks. We get potential turning signals in as low as 1, 2, or 3 sessions. So in this one session, we should see, as being detectives in the market, that if we were long on this breakout over here, we should certainly be scaling back on long positions, or maybe even liquidating the long positions. Now, for those who aren't long, you might actually want to go or think about going short. I particularly like it when the market breaks above resistance area and the new highs fail to hold. And one of the things we could do is, as I mentioned before, previously the market was in this box or lateral trading range. So it looks like the market is stalling via the doji at the top end of the box range, and a target could be the bottom end of the box range, which we did get to. In fact, we may have covered over here. This is called a Harami pattern, small real body and a big real body. So this is just a sample of not only understanding the candlesticks, but what to do when you see the candlestick lines. Do you go long? Do you go short? Do you stand aside? And so forth.